What we know is a drop. What we don't know is the ocean.
Hello and welcome to the Newton Knowledge Podcast. My name is Mark Singer, partner of Newton One Advisors, and I'm joined by our managing partner, Steve Target. The Newton Knowledge Podcast will provide meaningful content to our valued advisor community. Our discussions will deliver unique insights into the people, processes, and products that make our industry so critical. Newton One is a national life insurance planning firm delivering customized solutions structured to help clients and their advisors engaged in solving estate planning, wealth transfer, business succession, and executive benefits challenges. We are a member of the M Financial Group, which grants our clients access to the nation's elite carriers and exclusive products available only through our network. Today, we are fortunate to have the time to speak with Kyle Davis, Senior Director of Product Development and an Actuary with the M Financial Group. Kyle, thanks for joining us. Please take us through what you do day to day for M Financial and all the firms you partner with, as well as any career intel you can give us in terms of how you got to where you are today.
Yeah. Thanks, Mark. Thanks for having me on. Like you said, I'm Senior Director and Actuary at M Financial, so I lead our product development area. We've got a team of actuaries that work for me. Anything product related comes through us. M being a little bit of a smaller company, we wear a lot of different hats, so we never know what's going to happen day to day. But generally, product, usually proprietary product with M and our carriers, but anything product related comes through us. I have been with M now for 3.5 years. Before that, I was with a large life insurance carrier. Most of my background is on the actuarial side, pricing, product development, that kind of thing. I do kind of think of myself more of a non-traditional actuary, so I took a couple stints outside of the normal actuarial world along the way. I was on an innovation team, and then I was on a strategic planning team, so not really actuarial in nature, but still have that actuarial background. I've been doing product development at M since I got here.
So in terms of our topic today, guarantees within life insurance products, and are they worth the additional or extra cost? To kick it off, can you explain what a guarantee is within a life insurance policy, and why they have become, I guess, more popular over the years, you could say?
Yeah. Guarantees have always been part of the life insurance story. It just kind of depends on what you're thinking is guaranteed. If you think term insurance, whole life insurance, GUL, as a policyholder, if I pay my premium that you tell me to, my death benefit is guaranteed. That's a guarantee. If you move into the more, flexible premium universal life side of things, guarantees look different. If you're thinking about IUL, you've got your floor, you've got your cap, so there's an inherent guarantee with the floor. If you move into the riskier side with the VUL, that's when the no lapse guarantees come in. And so guarantees have always been part of the life insurance story. It's just what flavor of guarantee we're actually talking about. Specifically on the VUL side, where this guarantee, you actually have to pay a little bit more for it. It's a little bit more separated from the actual product itself. You're dealing with a lot of the market risk, a lot of the volatility, policyholder concerned about, what if there's a market downturn and my account value is no longer sufficient to carry my policy? I still want to be protected because I bought life insurance for a reason. I want that protection from a guarantee perspective that, there's something going on in the background that's going to keep me in force. And that's what the no lapse guarantees are.
So let's dive down into that a little more. If we think about, we'll stay in the universal life space for a second. We think about the no lapse guarantee universal life contracts, which, as you said, if we pay X premium, we're going to have Y death benefit. We define the duration of the policy. The amount of premium that we pay determines the duration. If we pay a little more premium, then the duration's a little longer. If we pay less premium, but as long as we stay, and there are some, we should note there are some rules to paying premium, when they're paid, how they're paid, and so forth. So that has to be clearly examined when clients are moving forward with these sort of contracts. If we compare that no lapse guarantee universal life policy to a variable universal life policy, perhaps with no lapse guarantees built into the contract, what does that do internally for the cost? As an actuary and you're pricing these, there obviously is a cost to have that rider on the variable policy. And is that cost, I don't know if it's going to vary, I'm sure. Is it an extra 10%, 20%, 30%? But can you dive a little bit into that for the consumer who may be interested in some of those guarantees, what the extra costs are?
Yeah. So if I'm a policyholder, I just see the end. Oh, if I want to guarantee out to age whatever, it's going to cost me an extra 10%. That 10% is really all that I see. But in the background, the carrier has to figure out what is that cost, what goes into that, and it's a lot more convoluted than normal. Just looking at a normal mortality risk or something like that. There's a lot of reserving requirements, especially on the variable side. Like if you have a VUL, you want to add an NLG to it. There's a lot of reserving requirements that go on in the background that the carrier has to make sure that they've got enough money. You run at a normal deterministic interest rate scenario, 5 or 6%. Guarantee should really never be in the money. If you start running a bunch of stochastic scenarios and interest rates are bouncing all over the place, sometimes just in modeling world, this guarantee is going to be in the money. The carrier has to make sure that they've got the reserves on hand at any point in time that guarantee could be in the money, they have to pay out for it. So it takes a lot of capital from the insurance company's perspective to make sure that they're covered. So it's capitally intensive. The carrier then has to think, okay, well, there's not only the cost that I have to hold this capital, but there's the opportunity cost that I could be doing a lot of other things with this capital, going into less capitally intensive products. So that's not an inherent cost to the carrier, but it's an opportunity cost of I could be doing a lot of other things. This is expensive for me to have this guarantee on my books. And so then that gets passed on to the policyholder as well. And then added on top of all of that, carriers have different risk metrics that they look at, where it's not just the IRR of a product and that's the end all be all and that's all they look at. A lot of different carriers have different metrics that they look at, and guarantees look different depending on which carrier you're talking about. Some have international parent companies, so they use more international standards. Some are US based, so they use US standards. It's really runs the gamut of how risky these guarantees look and how they are compared against other products. So all that to say, there's a lot going on behind the scenes, and it's not just a straight, 10% extra gets me 5 years of guarantee.
One of the phrases that's always been used on the advisor side of the world is, or one of the questions and then one of the answers, what's the best type of life insurance policy to own? And we all laugh at this because, the answer that we give is it's the life insurance policy that's in place when you die. And so for us, face-to-face with our clients, prospective clients, their advisors, understanding what the risk tolerance of that client and their family, if we're talking about personal estate planning, businesses, if we're looking at long-term structuring of policies for business ownership, all of that factors into whether paying that price is a wise financial move. And sometimes, clients will say, I understand it's going to cost me an extra 30, 40%. And the probability of that guarantee actually paying off, in other words, as you said earlier, at certain assumptions that we make when we price policies, the probability that a guarantee is actually going to be worth it, if we're conservative enough in the pricing, the probability is probably, reasonably low. But having said that, it still may make sense for clients. So from a carrier side or an actuary side, again, is there any metric or thought or calculation that goes into place thinking about pricing those guarantees? In other words, at what point does the guarantee just become outpriced and nobody's going to want to buy it?
I always say NLGs on VULs in particular, it's not a mathematical equation. It's the psychological side of things that really sells this. Because like you said, mathematically, probability would say the probability of this guarantee actually is meaningful to you and actually comes into play very, very low if you design a variable product correctly and you fund it semi-conservatively and you have firms like our firms who know exactly what they're doing and they're experts in their area and they're staying on top of it. This guarantee, there's very low probability that it actually comes into play mathematically, but there's the whole psychological side that is worth a lot. And that is both a psychological side from the policyholder, where they know that they are accepting a higher cost for something, but they're going to be guaranteed. So they don't have to worry about it. There's also the psychological side from the producer of, it is a lot easier to have conversations with the policyholder if I know their policy is never going to be underwater. It's easy. If you follow, carrier tells you to pay X amount every single year and you're guaranteed, it's a lot easier to have those conversations knowing that there's really no risk on that side. There's only the upside of the variable product. So it's the psychological, not the mathematical.
Yeah, no doubt. And, then the conversation also becomes from the planning side. If we don't need to deploy extra capital to pay premiums, and that capital can be used for other reasons, that could be helpful as well to the end client, right, whether that's an individual or family or a business client. Is it possible, based on studies, to give us probabilities or how often do these guarantees how often are they actually used? We've been talking a little bit in generalities, and I don't know if that's possible because there's so many variables that go into it. But if the policy is priced appropriately, fairly, conservatively from the beginning, from a design standpoint, is it a 5% probability that the guarantees are going to be used, 10%, 40%? And again, I don't know if that's a fair question or not, but I'm curious.
And don't get it wrong, Kyle. Be specific.
Well, if that's the case, I will caveat the heck out of my answer here at the very beginning. But no, it depends on what's the age of the person that you're selling it to. If you sell a policy to a 35-year-old, they've got a longer time horizon to weather some of these downturns, where guarantees going to be much less meaningful to them, where we know over the long term the market's going to return 5, 6, 7, 8%, whatever. They have the time horizon on their side. If you're talking about a 75-year-old, much less of a time horizon. So the caveat to the answer is very much depends on who we're talking about on the individual level. But in general, there is less than a 5% chance that this guarantee is going to be in the money when you need it, with a conservatively funded VUL that is managed appropriately.
Management's not really the topic of today's conversation, but critical, absolutely critical. And it's something that all of us at M, we place as table stakes. We've got to review. We need to have conversations at least on an annual basis with our policy owners, so that everybody understands, are the assumptions that we made, are they still fair assumptions, or do we need to make any changes, any course corrections as we go along?
Mm-hmm.
So sticking to the long-term planning aspect or clientele, understanding guarantees and non-guaranteed contracts within VULs, what information or what intel would you give a long-term planning client when the opportunity to implement or not implement guarantees within a policy comes up? What would be your advice?
M has done several studies. We've got white paper out on it, but you look at any 20-year period of the S&P, and you put that return into any of those 20-year periods, put that return into a VUL product, chances are you're not going to need that guarantee from a mathematical perspective. Now, psychologically, if you want that risk protection, you got to decide how much is that actually worth to me, and then how long do you want that guarantee for? Some of our products have flexible duration guarantees. So you say, I only want to pay for a guarantee to age 90, and I will accept the risk past age 90. That's obviously going to be a lot cheaper than if you want a full lifetime to age 121 guarantee, no matter what happens, I'm covered. So, and that varies by carrier as well, of how they view the risk, where, if you want to buy a guarantee to age 90, say, it might be 5 or 6% more expensive, but you want a guaranteed age 92, then you're at 30% more expensive. Like, there is some tipping point where the carrier says, that's too long of a guarantee for me to be on the hook for. I want to price myself out. I'm comfortable with the part before that. So it's going to be an upcharge, but not significantly so. And then you reach that breaking point and it just skyrockets.
When I look at it, with what you do on a day-to-day basis from an actuarial standpoint, as well as the actuaries at M, you guys are really close when it comes to collecting all the medical information on essentially when someone is going to pass. In all reality, is that a fair assessment? I mean, if you look at history, and I know they've done this with a lot of presidents in terms of actuarially speaking when they are going to pass, you guys aren't far off. And I know that only gets better with more information and more data. So when we get involved with an engagement and we have a policy that we're proposing, a few policies, and actuarially speaking, the client may live till 90, then having the conversation, well, I want the policy guaranteed to 95. How do you feel about that with those engagements? I mean, that has to come up, right?
Yeah. So going back to the first part, what you said, like we have 40 plus years of reinsurance data to support all of our assumptions on how long people are going to live. That is something that is very different than most other distribution networks or companies. Nobody else really has this reinsurance company that has this vast amount of data that we have on our policyholders. So by and large, we have a pretty good idea of how long people are going to live, and it's probably going to be longer than most other carriers would have the data to support. So knowing that, you're right. Like most of our potential policyholders, they're probably going to live past 85. They're probably going to pass before 95. It's somewhere in that corridor that it falls. If that's 90, 91, 92, it all depends on underwriting, all that kind of thing. But that's generally the sweet spot. So it depends how old this person is when you're starting the funding. If you fund it appropriately and you're covered through the early years of, you got a downturn, you want to protect yourself against that, you've got time to make it up, you're probably okay with a guarantee to 90 if you've got enough time to weather anything that is adverse to your account value. Now, if you're funding an 80-year-old or something, maybe you want to go a little bit past 90 just to make sure that, 3 years in, something terrible happens to the market. Let's make sure that we're covered. So it all kind of depends on the individual case that we're looking at.
This has been great. Is there anything else you want to add, Steve, while we have Kyle?
No, not for me, but Kyle, is there anything that we should have asked you that we didn't ask you?
No, I mean, the only thing, and this is outside of the actuarial side of things, but this conversation is different when we're talking about M member firms, M products. We have the best producers in the industry. We trust you guys to know how to service these policies, how to design them correctly, lessening the need for a guarantee even more. Whereas if this were on the non-M side, less expertise in this area, maybe not as servicing it as closely, maybe there are higher needs for a guarantee just to protect you. So I think this just speaks to the value that you guys provide and the value that M has behind these products.
Kyle, you put your actuarial hat to the side. If you didn't have to sleep, what would you do with the extra time?
If I didn't have to sleep with the extra time, I'll answer it two different ways. One, anything active. Like my wife and I are really anything outside, anything active. My wife plays pickleball like 5 days a week. I'm not to that level of craziness right now, but pickleball, golf, running, exercise, anything. If we didn't have to sleep, we'd be doing something active. Separate than that, we enjoy doing unique things with our friends and our friend group and our family around. And that is anything from like minute to win it games, like silly things like who can slide this ice cube closest to the edge of the table without making it fall off. And that's worth a point. Or, we do scavenger hunts through downtown Greensboro where we live in North Carolina and go do silly stuff with strangers on the street. So two different answers to the same question, but that's probably how we'd spend most of our time.
Awesome.
Thank you for your time, Kyle. This has been great.
Yeah.
Really informative. Probably the foundation of what we do at the M Financial Group. So really appreciate your time and all the insight you provided.
Yeah, definitely. No, it was a pleasure. Thank you guys for having me.
Thank you.
Bye. Goodbye.
The material and opinions voiced are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what is appropriate for you, please contact a member of our team.